In this video I'll walk you through the first step here, which says to prepare the appropriate entry for the lessee on the inception of this lease. So, there's not a whole lot of information given here relative to the lease, but don't let that fool you. This is a very complicated problem here when we look at the accounting and the appropriate way to record the inception of this contract within our accounting records. And what we learned so far, remember, the lessee is the person that gets to use the object that's the subject of the contract. The lessor is the one that owns it, and you think of a rental agreement, they're trying to earn money off of it. So we're looking at the lessee, which is the person that wants to use whatever property, and in this case it's a satellite transmission device, so maybe something floating up around in space. And so when we look at that lease, remember we talked about two different types of leases, one being a capital lease and one being an operating lease, and they're accounted for very, very, very differently. An operating lease is extremely easy to account for. You would debit rent expense or operating lease expense, and you would credit cash, and that's it. Assume that it's a true rental agreement. However, if it's a capital lease, then the accounting is much more complicated. So the first thing we're going to do is try to categorize the lease as either a capital lease or an operating lease. And I brought this down here. I know we went through this in class just to kind of jog your memory. And the way that we determine whether it's a capital lease or an operating lease is we apply this methodology that says, okay, there are four main questions, and if we can look at the lease and answer no to every single question, we have an operating lease. But if we answer yes to any one of these, we have to categorize this as a capital lease, and the accounting subsequently is the item is accounted for using the capital leasing requirements. Okay, so the first question asks, is there transfer of ownership? So after the end of the lease is over, does United Cellular, the lessee, get control or title to this satellite floating around in space? And this problem mentions nothing about that, because that would be just absurd, right? I mean, there are lots of companies assumed to be using this satellite, and so why would they get the satellite? And so since there's nothing listed, we have to make an assumption that no, there's no title transfer. Okay, great, we've answered no to that first one. So the second criteria, is there a bargain purchase option? Again, nothing listed here. The bargain purchase option would be a way for the lessee to acquire the leased asset at the end of the lease term. Nothing mentioned here, so there's no bargain purchase option. We're 2 for 2. So the third one says the life of the lease. You need to look at the life of the lease. How long is the lease? 3 years, 6 payments. And you compare that to the economic life of the asset, 3 years. They equal, right? So in other words, the term of the lease is 3 years, is 100% of the life of the asset. So it is greater than or equal to 75%, so we answer yes. And that tells us we need to account for this transaction, assuming that this is a capital lease. Okay, so we've established that it's going to be more complicated accounting, but how do we then journalize this so that we get the right balance sheet items and the right income statement items? The assumption then is, even though we don't get to take physical control of this asset, we need to put it onto our records as a leased asset. So what sort of value do we use? We calculate the present value of the minimum lease payments to determine this first journal entry. Present value of the minimum lease payments, we got to go back and dig through all of this information. We know that we're going to be making, if we're the lessee, a payment of $120,000 at the beginning of each period. And there are 6 periods, there are 6 semi-annual periods. So we're going to make $120,000, and I've got a little, you can barely see it here, timeline for us. This is a 3-year lease. We make 120,000 payments here, right when we sign the lease. Again, 6 months later. I guess that this should probably be, I can't change it in that picture. Let me do this. Hold on, I'll be right back. Okay, I'm back. Sorry about that. You'll notice this magically changed. I realized I had an error there. If you look at the timeline, it's a 3-year lease. These arrows are kind of messy now, but they're supposed to indicate we make a $120,000 payment at the beginning of the first year, we sign the lease, then 6 months later, so that's the second payment, 6 months later, third, 6 months later, fourth payment, 6 months later, fifth payment, and 6 months later, sixth payment. So those are all of the cash flows relative to this lease. We need to figure out, well, what is all of that worth today, right here, when we sign the lease? And this becomes a present value problem. We're taking all of these future cash flows, discounting them back to the current period, and saying, okay, that's what our lease liability needs to be recorded at, and the leased asset needs to be recorded at the same value. So we need to go through this process of discounting all these cash flows to today's date, to today's dollar value. Alright, so the way we do that, cheating here, you see the answer already, but so we know, thinking way back to our discussions on bonds and other long-term notes payable and receivables, that we need to we're going to use the factors, the tables. You can use a present financial calculator, but I'm going to use the tables again because the CPA exam uses the tables. So the number of payments, if we count all those up, we're making 6 semi-annual payments. The rate of return, 12%. However, that's an annual rate. Since we're making payments every 6 months, we cut that in half the payment is 120. That's the size of the payment. The rate is 6%. So 6 payments at $120,000 at a 6% rate. I need to figure out what the present value of this is. And if we use the table, we got to first identify whether this is an ordinary annuity or an annuity due. An ordinary annuity would say we make payments at the end of the period, and we don't do that here. We make a payment right up front. So if we make a payment up front, that's an annuity due. So I've got a present value of an annuity due table here. I go over to 6%. I go down to 6 payments, and I've circled it in red. 5.21236 is my factor. I multiply the factor times the payment. This is the present value of all the minimum lease payments, $625,483.20. In other words, that's the leased assets the leased asset and the lease liability get put onto the lessee's records at this value. Okay, so let's look at some journal entries. At the inception of the lease, we have a leased, we're the lessee, the leased asset and a lease liability. We debit the leased asset for this amount, and we credit the lease liability for the same amount. That's one entry. Second entry we would make is we make this $120,000 payment right away. So we have to pay that cash. So cash goes down, credit cash for $120,000. That's the size of the payment. We don't have any time that has passed within this loan, if you want to call it that. So no interest expense is recognized at the inception of the lease. Instead, this $120,000 payment reduces the amount of the lease liability outstanding. So we remove or reduce this lease liability by $120,000. So these are the two journal entries that I would expect you to be able to calculate. Certainly a long process to get there, but once you understand the rules of capital leases versus operating leases and you combine that with the present value concepts, certainly doable. So this would be the answer right here for that very first requirement.